VP Singh, Executive Director and Chief Investment Officer with Pramerica Mutual Fund, joins us live with his take on Indian markets. Mr. Singh, good morning. Thank you for joining us. We've come a long way and Nifty has appreciated by about 1,000 points plus from the recent low. Do you think in the short term the risk-reward ratio is not favorable? Some degree of complacency has kicked in?
Good morning. Yes, I agree with you. If you take a short-term view, particularly on the large cap stocks and more towards the big ones in the index, you will find that some amount of overvaluation case is getting built up. And so if one is analyzing the broader index, then obviously some amount of consolidation is needed. The expectation of the positive feeling which came, and that's why the market rallied, was initially when the rupee had depreciated, and you notice that most of the results reported by the corporates who are in exports or export-oriented businesses, etc., have been quite good. But the same now goes against them because the rupee has appreciated a bit, and so the amount of depreciation which we have seen no more exists for them. So therefore it's important that we take a breathing, consolidate, and then based on how the scenario emerges, the market makes a fresh move from there.
Right. So Mr. Singh, in last 3 months, markets have fluctuated from extreme fear to over-optimism. Where do you think we will settle?
Well, if you see, there are two things which are working at this point in time. The underlying economy is obviously getting weaker day by day, whereas the markets are driven mainly by what's happening in the United States and globally, and the amount of liquidity which is being put into the system. So just as you have an inflation in the underlying economy, you are almost like an inflationary situation exists on the other asset classes, including equities. So same stock appears a little bit more costly and it keeps going up. Now, these are the contrasting situations which continue to appear, and when the markets are driven by this top-down flow, the conviction in the market is usually very low, and that's why the kind of volatility which we are seeing. Now, what we need to actually wait and see for the consolidation in the economy. Now, economy is not going to turn around tomorrow. It's going to take time. And any economy which goes through a slowdown needs to consolidate, where some weaker players needs to vacate space for the stronger player, and that consolidation only will drive the economy further. However, the markets are obviously going to read it earlier. So what I see from here in the next 2 years' time, the volatility probably in the market which we have witnessed, in the matter of next 3 to 6 months' time, that volatility is going to come down, and market will actually start picking up those stories where it realizes that they are strong businesses, they are cash rich, they are comfortably placed to take advantage of the difficult situation which is presented to them. And then the market actually will rally first, followed by the economy which will revive. So most of us will continue to find out the reason why the broader market actually got into a recovery phase, but we will end up justifying after some time when we see that the consolidation is actually taking place. So what one should be looking for at this point in time is the news flow, where a lot of mergers and acquisition kind of stories which will come around, and that actually will start driving the market.
Mr. Singh, hi, morning. There's the RBI credit policy as well come next week, and there is expectation that repo may be hiked by 25 basis points. Do you think that is something that the market is already working with, the assumption of it happening?
Well, the market, if you see, while talking, is actually admitting that there would be a rate hike. But every time in the morning we decide and we discuss and think the rate hike will be there. But when the flow comes, people just ignore it. So market is at this point in time ignoring that the interest rates are going to firm up, the inflation is actually coming back. So that's a point which I made, that the fundamentals are actually at this point in time not supporting few broader stories where the flow is getting consolidated at this point in time. Rest of the economy, if you meet the corporates, you speak with them, you actually realize that they are prepared for it, and hence what you see, the slowdown, the kind of inventory cut which most of the corporates are going through, is actually taking place. But the market as such actually keeps ignoring that there will be a rate hike, and as and when it takes place, and in our opinion it will, the market is obviously going to react a bit negative on that.
IT companies have delivered. The management commentary is strong. Discretionary spending is picking up. Deal outlook is looking robust. So despite a rosy environment, why are IT stocks down?
Well, actually, there are a couple of reasons. One, obviously, they did very well in the last few months. So the portfolios are sitting on huge profit, and so a little bit of concern here and there is an excuse to book profit. Now, once the US government shutdown is over, the immigration bill has again become a reality, and people have started talking about it, whether it will be introduced and how it will move ahead from here onwards. Simultaneously, the US growth numbers are not appearing as strong as they were, say, a couple of months ago. So keeping these facts in mind, those who are sitting on profit, they are booking partial profit. However, in our opinion, I think the factors which help this particular sector is that we do not see US economy actually slowing down so much. In fact, in our opinion, it's bouncing back reasonably well. The global PMIs have started coming up, and so you will see a good trend as far as this sector is concerned. And the last and the most important thing is that we believe that if you take a medium to long-term view, the Indian currency is actually set for a depreciation from here onwards. So all these factors actually are positive for it. But in the short term, the stocks are correcting, and in fact, we have also booked a little bit of trading profit simply because the stocks have run up well and they need to consolidate in order to move ahead.
Mr. Singh, what have you made of the cement earnings so far? Acutely disappointing performance from all three majors, ACC, Ambuja, or for that matter, and Ultratech. But it is the price hikes undertaken this quarter and the expectation of that trend to continue, which seems to be surfacing the stocks back in the green.
Yes, I think the cement sector, you should ignore the last quarter results, simply because if you compare year on year, you will find that last year the monsoon actually was not so strong for throughout the year, and its period of activity was lower. In compared to that, this year we had a very extended monsoon, and as a result of its last quarter, the cement numbers were quite subdued. However, if one looks into the month of October, you will notice that the prices have come back and the volumes have picked up. No, we are not saying that the volumes have picked up extraordinarily, but it is in line with what the general market was expecting, and so therefore the market is ignoring last quarter result. Market is taking note on what's happening now. The other development which is taking place in cement is that last 1 to 1.5 years, some amount of consolidation has started. You find that some of the cement players are now getting weaker financially, and so they are now in a position where they want to get out of their capacities, and the others are actually acquiring. Any industry which goes through a phase of consolidation actually is always liked by the market, and that's something which is in favor of the sector, and that explains why the investor, despite not a very good result, are still picking up the stocks.
Mr. Singh, as of now, liquidity signals are blowing strong. Do you think till the time we don't get a definitive timeline on when Fed will taper, will this market be dominated and dictated by bulls? Will dip buys dominate this market with the assumption that Fed tapering is not happening and liquidity will be intense?
Yes, you're right. Till the time there is some kind of indication from Fed that there is no tapering, the liquidity and will continue to remain, and the risk on will remain. Now, what we believe that yes, it's not easy for the Fed to actually go ahead and taper quickly. But looking at the kind of illiquid market which is getting built up in the US Treasuries, probably there will be a change in the nature of the QE which is taking place. That is, reduction in the amount of treasury bill purchase, and probably maintaining the mortgage securities purchase as it is. So that kind of scenario might emerge in the say month of December when their policy comes. So market might have a surprise there, the negative surprise, and that could have a big impact, because at this point in time market is assuming that the tapering is postponed till at least March, and we are in a comfortable situation. So yes, it will drive, but at the same time there could be a surprise in terms of it might not sustain till March.